All right, let's get started. Call to order the special board meeting of Thursday, August 13th. We have a quorum.
We have a quorum.
No non-agenda public comment.
No public comment.
All right. Section 3, business operations, new business, staff and consultants recommendation for a $50 million commitment to the Davidson-Kempner Special Opportunities Fund 3.
Okay, so that's what we're going to be discussing at today's meeting. The way we're going to move through the meeting is we're first going to have comments from Steve Voss and Katie Comstock from Aon Hewitt, and they're going to provide their perspective on the investment and why it's a good fit for SDCERS. And then we will have Melanie Levine from Davidson-Kempner give a presentation, and she will tie in one of their portfolio managers to talk more specifically about the strategy. Then she will leave the room, and the trustees and staff and consultant can have a further discussion, and then we will have a vote. So with that, I will turn it over to Steve and Katie.
All right, thank you, Liza, and good afternoon, everyone. There's a couple people on the phone. One of our colleagues, Miriam Schobloom, is on the phone, as well as a portfolio manager from Davidson-Kempner, so we will hear from them here in a few minutes as well. I'm just going to make a couple very high-level introductory remarks. I know you have our written material. There'll be time for plenty of questions and answers after our conversation and after the discussion with the manager, Davidson-Kempner. But what I wanted to do is talk a little bit about the timing. You all called a special meeting today. I wanted to give some references to why that was needed, and thank you for that. Also talk about the fit, and then talk just conceptually about the framework for the Opportunity Fund. There's a number of board members here that aren't a member of the investment committee, so just wanted to tie that group in as to how investments are made in the Opportunity Fund and why we think this is a good fit for that particular investment vehicle for SDCERS. First on the timing, this is an opportunity that came to us at the very end of June, and it took us about 2 to 3 weeks to do our due diligence, which is a fairly fast timeline. So I applaud our team and the team at Davidson-Kempner for coming together and doing that work quickly, giving you what we think is a very thorough and complete analysis of the investment opportunity. It's going to go away pretty quickly as well. They will have a close next week and a final close later this fall, and then that opportunity will be gone. So sometimes investments come to us that don't fit neatly into the cadence of our regular meetings, and it's great that you all are flexible and can work timely with your consultant and with your investment team to bring things like this forward. We don't expect this to happen all the time, but from time to time there will be interesting investment opportunities that will be short-term in nature, and we want to be able to pull the trigger on those and bring them to you. So thank you for that. Let's reflect back a little while. It's been, I think, almost 2 years since the first opportunistic investment was made. Recall that there was a theme that we wanted to take advantage of, and we talked a lot about this credit dislocation and the deleveraging of bank balance sheet and corporate balance sheets across the globe. And that's something that we've been talking about at some great length. I think it was the May meeting of 2013 when it was first introduced, and then later an investment was made with Grosvenor Capital Management out of Chicago, a very diversified credit investment, $120 million. It was the first of its kind that was put into the portfolio. This is, in a way, a continuation of that same theme, and you'll hear from the portfolio manager, Avi. We'll talk a little bit more about the market opportunities that they see today and the types of investments that they will be making. But it's also very different from your existing credit investments that you have in the portfolio, and I want to draw some attention to that. In our memo, we cite some of the key differences between the two types of investments. I won't go through each item in detail there. We would expect this to be a lot more concentrated investment than what we've made elsewhere. We think that's good, and we can talk more about that during the presentation from Davidson-Kempner or after. There will not be any foreign currency risk. That will all be hedged. There will be investments made in European assets. We also think that's good from a diversification standpoint. Let me back up and talk again about the framework for the Opportunity Fund. There were 4 key different things that we always wanted to keep in mind when we're looking at investments for that. One was the investment objective. What does it do to the total fund? What characteristics does it bring that we otherwise don't have? Is it diversification? Is it return enhancement? This is predominantly a return enhancement investment vehicle. Recall at the last meeting we talked about your cap market assumptions. the mix between stocks, bonds, real estate, private equity, and what we think you will earn over the next 10 to 20 years, that number is small compared to what your actuarial needs are. So an investment like this, while timely and opportunistic, we think will help increase your odds of getting the actuarial rate of return that you need for your investments over long periods of time. That's the investment objective. We also want to be mindful of new investment risks that are brought into the portfolio, things that you may not have today. And predominantly, this is a credit-related investment, and so there'll be default risk and credit risk, mark-to-market risk as well. We think those are all mitigated by the excellent manager that you'll be hearing from in just a few minutes. Concentration risk is another feature, but the sizing of this total investment at only $50 million, the negative impact it could have on the total fund is relatively modest in that regard. Implementation, another thing that we always need to keep in mind when we're looking at investments, is how do we get access? Does it make sense for SDCERS to gain access to this type of vehicle? And I'd like to spend a minute on this. So what you're investing in is basically an overflow fund, and Davidson Kempner may go into greater detail in a couple of minutes, where they're not able to take full positions in certain investments in some of their other funds. So they need a spare pocket, a balance sheet, if you will, to be able to go out to the market and take large positions in individual investments. This gives them that opportunity. This is nothing new. In fact, in the industry, we see this quite a bit with some of the very largest of large public pension funds, your mega peers, if you will, where some of their managers will come to them and say, hey, we would like to do this side investment with you. What I like about this a lot is that it gives you that same access and that same opportunity that some of your very large peers have access to, that heretofore investors of your size, $7 billion is sizable, but it's not $100 billion, you haven't had access. So I like that aspect of this quite a bit. And then the other item that we always want to look at, just other relevant factors, other risks, the liquidity of the fund, the use of leverage, and so on and so forth. We went through all of those things with your investment team at great length. We've conducted a series of conference calls with them, going through the terms and circumstances, the types of investments that will be made, and the overall fit, and came to the conclusion that a $50 million investment is warranted and would be additive to your total investment program. I'm going to pause there and ask my colleague Miriam, who's on the phone, to make a few high-level comments as well about the firm and about the investment opportunity as well. Miriam?
Thanks, Steve. Good afternoon. Thanks, Steve. Good afternoon, everyone. And as Steve mentioned, we see this as a continuation of this theme, an investment taking advantage of bank deleveraging, especially in Europe for this opportunity. But even though it is part of a theme, we still think it's very important for our clients to be very selective about which managers they choose to invest with in this area, because we don't think that every manager is set up to succeed with this kind of strategy. The managers we think are best positioned to capitalize on this environment are those with an established global presence, deep resources, and a strong risk management culture. So when Davidson Kempner informed us in July that they were launching this second overflow fund to invest in just these kinds of distressed opportunities alongside its other distressed funds, we were excited about the potential this fund would have for our clients and got to work underwriting it right away. Davidson Kempner is a firm we know well, and our clients have been invested in their strategies for years. It's one of our highest conviction event-driven and distressed managers, and it checks all the boxes that I just mentioned. The firm has a large, experienced, and stable distressed investment team. They've had an investment team presence in Europe for more than a decade, which is really critical for this fund because European bank asset sales have been the biggest source of opportunity for the strategy so far, which you'll hear the firm discuss in just a minute. Many of the firm's competitors, by comparison, have had to play catch-up in building out their European teams in the past few years. We also, really have a lot of conviction in Davidson Kempner because among distressed managers, we found them to be laser-focused on downside protection and evaluating each transaction that they invest in. And that manifests itself for the Special Opportunities Fund 3 in a number of ways. Partly the team's emphasis on investing primarily in senior secured debt rather than migrating down the capital structure in search of higher returns, as some managers have done in recent years. That attentiveness to protecting against losses is also why we're confident this fund can be successful with a relatively concentrated portfolio of 8 to 10 investments, as Steve mentioned. while the fund does have the ability to use a modest amount of leverage, it's not a big part of the strategy. And that's another area where we've seen managers look to compete on returns by making investments and then adding leverage to them in the portfolio in order to make a targeted return. And that's not really the main focus of Davidson Kempner's strategy here. I'd also like to just make a quick note on fees before turning it over to Davidson Kempner. Investors committing $50 million or more have the option to choose a fee structure of 50 basis points annual management fees and a 15% incentive fee. The other option would be a 75 basis point management fee and a 10% incentive fee. And I also note that management fees are taken on invested rather than committed capital. Both of these options look very attractive to us, especially when you consider that the fund is investing alongside other Davidson Kempner funds that are charging 1.5% management fee and a 20% incentive fee. And in general, this fee structure offer here represents, a significant discount over what other opportunistic credit funds that are out there in the market have been offering. So we think it's an important consideration when evaluating this deal as well. So with that, Steve, I don't know if you have more comments before we turn it over to Davidson Kempner.
Well, maybe we'll pause and see if the board has any questions or comments of us, and if not, we'll hear from the manager. Miriam will stay on the line after Davidson Kempner presents, so there's plenty of time for Q&A from after that as well. Bill?
You mentioned the concentration in Europe. You've been there a few years, 10 years or whatever. What about Asia? How long have you been in Asia in that area?
Let's bring you up, yeah.
Great. Hi, everyone. Good afternoon. I'm Melanie Levine. I'm in my 11th year at Davidson Kempner. Thank you so much for the opportunity to come and speak to all of you. So we've been investing in Europe since the 90s, but we've had an office there since 2001. And today we have 52 people, 18 of which focus on distressed investments. In Asia, we started an office in 2010, and today we have 11 people there, and there's 4 people in distressed investments there. So with that, maybe I'll take a step back and introduce you a bit to Davidson Kempner, explain who we are as a firm and what our focus is, and then we'll walk through really the evolution and the opportunity set within the special opportunity funds. And I'll also introduce Avi Friedman, who's the distressed portfolio manager that's going to be joining us as well on the conference call. So Davidson Kempner is an event-driven, fundamental, bottoms-up investment firm where we're really focused on downside risk and preservation of capital. We've been around since 1983. Our founders, Marvin Davidson and Tom Kempner, started investing together in merger arbitrage and distressed investments in 1984, and it was really only Marvin Davidson's money until 1987. Then we started taking outside capital. In 1990, we registered with the SEC because we wanted to market to investors like yourselves, pension funds and other institutional investors. We hit $1 billion in 1995. Today we're over $25 billion. We have a deep team of 271 people globally. As we mentioned, 52 in London and 11 today in Hong Kong. The rest of the team is largely in New York. We do have a small Dublin office with 2 individuals as well. We're led by 13 partners. The 13 partners own the firm, and Avi, the portfolio manager that you'll speak to today, is one of those 13 partners. The 13 partners are all paid on the bottom line of the firm and not on their own profits, and they have $1.6 billion invested alongside you, the investor, and the partnership structure is quite unique at Davidson Kempner, and investors really like this because the partners truly drink their own wine or eat their own cooking. They are mandated to reinvest 87% of their after-tax profits back into the funds every year, and their money's locked up until they retire. We've never had a partner leave in the history of the firm, but we've had 4 retire, each after 20 plus years of service, and those 4 retired partners have over $500 million invested in the funds. So incentives are truly aligned between the leaders at Davidson Kempner and you, the investor. I'm one of 31 managing directors. We participate in the profits of the firm as well. And if you think about the distress team, we have 69 individuals in the distress team that will all be looking for opportunities for this special opportunity fund that we're going to be talking about today. And we focus on a lot of areas. We have 9 people focused on structured credit, where we're evaluating CDOs and commercial mortgage-backed securities and residential mortgage-backed securities. We have 7 people focused on real estate, which has been a big focus area for the special opportunity funds, and Avi will speak to in more detail. And so we have people that are focused on first mortgages and debt backed by the hard asset. We also have several individuals focused on aircraft leasing or shipping loans. So it's a very deep team with a lot of different expertise areas, all that we can use in this fund. In terms of assets, as I mentioned, we're over $25 billion. And when we look for opportunities, we have several different products that are focused on distressed investing, but depending on really the risk-reward profile, the duration, the liquidity of an investment, it becomes clear to us which investment is appropriate for each of our vehicles. So to turn to the special opportunity funds, since the 2008 crisis, really we've seen lots of U.S. and European banks trying to reduce leverage and sell assets. And really starting in the fourth quarter of 2012, we think the European banks started to really sell assets, and Davidson Kempner was very competitive in sourcing senior debt, situations that were 1 to 3 years in duration, low to mid-teens type return portfolios. So we first started splitting these trades with other funds or other banks, and Davidson Kempner was doing all of the research and really wanted to control the workout. But these trades and these portfolio sales were often too big, as the consultants mentioned, to be taken down by one of our vehicles. So what we decided to do was launch the Special Opportunity Fund 2 back in the summer of 2014, so last July. And the Special Opportunity Fund was an overflow vehicle intended to co-invest with the other Davidson Kempner funds. So now Davidson Kempner had the balance sheet to control the workout and to influence pricing and to influence a restructuring. So last summer we raised a Special Opportunity Fund 2, which was an $800 million fund, and several investors of ours, it had a very big institutional focus. So we had about 33% of the investors were sovereign wealth funds that participated in the Special Opportunity Fund. Over 40% of the investors were pension funds like yourselves that participated in the Special Opportunity Fund. So far we've closed on 6 investments in this fund, and we expect to be fully committed in the fall. So that's why we're launching Special Opportunity Fund 3 that we're speaking about today, because we still see a big opportunity out of the European banks. We estimate there's over 1.9 trillion euros worth of assets that these European banks want to get off of their balance sheets. So we want to have a follow-on co-investment fund that can participate in these sales that are just too big for the other Davidson Kempner funds to take in their entirety. So the plan is to close next week, which is the reason for this meeting, on the emergency basis, so we appreciate all of your flexibility, and that will be the first close. And then we will have a subsequent close in October, although I should tell you that we are looking very fully committed, so it is highly likely that people that would wait till the October close would have to be scaled back in their investment, which not every investment organization is as flexible to do a meeting such as this, so we appreciate that. And the goal is to raise up to $1 billion in this fund, and it will be a very concentrated portfolio. We estimate probably 8 to 10 investment opportunities, again with the reduced fee structure that the consultants mentioned. So, we're really excited about this opportunity, and we really appreciate all of your focus on this area. Again, the terms of the fund are an 18-month investment period with a 2-year harvest. So we expect to return capital within probably 2 to 4 years after that investment period. With that, I'd like to turn it over to Avi to talk about really where we're seeing opportunities and why we're poised to take advantage of these opportunities.
Thanks, Melanie. Thanks, everyone, for your time. This is Avi Friedman in New York. I don't have anything written or any presentations. I've just kind of talked to you a little bit about kind of what we're seeing from the desk, why we did this, and where we see this going forward. There's nothing, as Melanie said, there's nothing really new in this fund that we're not doing right now. It's not one of those situations that you get up and something's happened in the world and you decide that there's some great industry or great dislocation. Like some people are raising energy funds right now. It's not like that something happened. The deleveraging of the European banks has been going on for a long time. As Melanie says, it's been going on since like 2011, 2012. We have seen a constant flow of portfolios and of paper coming out of these European banks for several years, and we expect this to still have a good amount of years still coming. There's still over €1 trillion of non-performing loans on the European bank balance sheets. So far, a lot of the selling has been out of Spain, UK, Ireland. Those are the three big selling banks or selling countries. And we're starting to see a little bit of selling out of Germany. I hope that it sticks. I hope that because they have a lot of paper to sell, and it's generally pretty well structured and well documented, which is one of the things that we really care about. So we're excited about this opportunity. If the fund that we are investing right now, that Melanie said we had the 5 investments in, if that fund was double the size, we wouldn't be having this conversation. But we did a fund for what we thought was right then. We raised it. We're deploying it, and we're going off now to do the next fund. And I think understanding if you wanted to understand how we think and what types of investments get us excited, looking at what's inside the second fund, I think is a good periscope into how we think, because we don't see any difference really in the opportunity set, in how we approach the world and how we think about underwriting the downside protection. It's kind of going to be the same. And just to kind of underscore something that I think Miriam brought up, everything in this fund is something, it's not kind of a throwaway fund, oh yeah, let's just take a flyer on something. Everything that's going into this fund is a position that we love and that we're full on. So in order for something to make it into this fund, it's something that we are buying in another Davidson Kempner vehicle, and it's going to be a full position. And it's our own risk management guidelines in the rest of our funds where we govern ourselves about position sizes, that we will limit the position at that point, and then whatever's left over will go into the overflow fund. So it's not the case. It's not a best ideas fund, but it's also kind of not a throwaway fund. Everything that's going into here is something that we have a very high conviction on, and we've bought a full position in somewhere else. Now, the profile of what's coming out of the European banks tends to be the same, and the sale process, which I'm happy to go over if anybody's interested, it tends to be the same. These are loans that were written by European banks. They tend to be quite large. The portfolios are in the hundreds of millions of dollars of market value. There usually is some common theme in what's in the portfolio. It's usually because it's one borrower or a collection of borrowers that are connected. Maybe it's a geography, or it's an asset class, or sometimes it's an office that they closed. We saw a portfolio that was coming out of RBS that had to do with Australian assets because they shut down their Australian presence. They had a lending portfolio they wanted to sell there. So sometimes it's a hodgepodge of things, and it's varying quality inside the portfolio. But for the most part, these are senior secured loans that have some sort of short duration on them. It's usually because the event that we're playing for, which usually is a maturity that is going to go unmet, has either just happened or just about to happen. So we're slotting into the position. We take over the exposure from the existing bank. We're slotting into the senior position where we almost always have a security interest and a collateral interest in all of the assets of the borrower. The reason we like those, and I mentioned a couple of things here, we like the seniority because even if we're wrong, there's only so much money we're going to lose. We're going to get the asset. Sometimes when you go into a situation on a subordinated basis, you have a lot more risk of loss because you can get crushed if the valuation goes down and you're in a subordinated position. You can lose the asset to the senior creditors unless you want to come out of pocket and pay them off. In this situation, we are almost always, and I'm looking at the snapshot of the portfolio, I could say we're always in these cases a senior creditor. So there's only so much you're going to lose. It's not to say we can't lose money as a senior creditor. Plenty of people do, including ourselves sometimes. But it's that we are limited to the value of the asset. If we underwrote the asset right, we're going to be okay. And that's a key point. The second key point is the shortness of the duration. Institutionally, the way we look at these opportunities, and this is true in a lot of our other vehicles as well, we see ourselves as an event-driven investor. We're not here to make a long-term rate of return that appreciates in some linear fashion to get to terminal value. We're looking to accelerate and collapse the spread or accelerate the appreciation in the value, usually through some sort of restructuring process. That restructuring process sometimes involves an enforcement, sometimes litigation, sometimes it's consensual. There may be a refinance, a conversion to equity, an asset sale. It comes in a lot of varieties, but the gating item is there needs to be a reason for the borrower to need to have a conversation with their lender. And that is usually, at least in this environment and with the portfolios that are coming up, is a maturity has either come or about to come. The asset is over-levered. It's not refinanceable in the market. We think it's probably covered on value, but not covered on debt capacity, meaning they cannot just go to a bank and refinance. And not all banks in Europe and not all markets in Europe are functioning from a lending standpoint. And that's when they have to sit down with us, and we're going to have a very consensual conversation with them initially to try and work out the loan and put us in a better position. The anatomy of this restructuring is such that, and this is why this fund, even on the description that we're doing as far as the investment period and the harvest period, is quite short for locked-up funds. Locked-up funds are usually 7 to 10 years, especially in the private equity world. We don't think we need so much time because the kind of things that we're targeting, as I said, are pretty short duration. We get in, we do the work, and we move on to the other side. And that other side, well, takes time. Sometimes it'll take time to do the restructuring, but also takes time to get out of the asset on the back end. So we've given ourselves, we think, ample time to do it, but it's not one of those things that we think, excuse me, that we need, 5 to 10 years, because we're not really going for a real appreciation in the value of the asset. And this is what sets us apart a little bit. In a traditional private equity investment, you're making the investment because you think that either by the passage of time or by your hard work, you're going to increase the value of the asset. We're not doing so much in our underwriting on changing the asset. If the asset gets better or the market gets better, that's our upside case. Our base case scenario is the asset is what it is, the market is what it is, but the financial distress or the situational distress that they're in is what's causing the discount to fair value. Let us do something, collapse the discount, and sell this at fair value or better. That's basically the DNA. What I just described is basically the DNA of Davidson Kempner, and it absolutely applies to this fund as well. A little bit, I know that we talked a little bit, I think maybe Miriam or Steve mentioned the idea of sourcing and presence. A lot of these portfolios are indeed coming out of European banks, and a lot of the underlying collateral does happen to be in Europe because of that, but it's also not exclusively European bank selling, and it's not exclusively Europe. In this second fund, there's some aircraft collateral, which is not really European, it's kind of everywhere, and we have one position that's in northern Minnesota, so much colder than Europe, but there's a lot of things here that are in Europe. As a sourcing exercise, as we said, we have an office in London. We've been there since 2001. It's a big office. We're very well known, just like we're very well known in the distressed business in the U.S., we're very well known there. So the sourcing kind of comes to us also because we're a $25 billion fund. And I think if you took just all of our distressed portfolios and added them up, I think that we would be considered one of the larger pure play distressed funds. Now, we're not a pure play distressed fund, but that is how people are going to know us. But honestly, when I'm looking back at the sourcing, our challenge is not sourcing. Our challenge is more screening. And the way we improve our hit rate in these portfolios is by doing a better job screening them up front to see what is the kind of portfolio, what is the kind of opportunity that we're going to like, and not just go shoot at everything. If we shot at everything, we would spend tons of money and tons of man and woman hours just underwriting opportunities that we never get to. So the sourcing is important, but the internal screening that we've put together, I think, to me, is more important. As far as I guess finish with this, and you guys can ask me anything you want. The rates of return, or what we're really targeting for here, we try and buy things that are, call it, somewhere between, I'm going to say, 8 and 15% discount to true today's asset value. If we're buying things at more than a 15% discount to asset value, it's probably a hairier situation that's probably going to require longer duration, more work. Maybe it's more subordinated, and there's a reason something's so broken. This fund is more about generating a rate of return in a shorter period of time than it is providing a multiple of capital like some private equity funds do. So the dollar prices on these things, tend to be, I would say, above 70. So call the trade to be, 75 to make 90, 80 to make par, 90 to make 110. That's the sort of range. It's not the kind of portfolio, although obviously exceptions apply. It's usually not the portfolio that it's kind of the 30 to make 60. And I'm talking, the numbers that I'm quoting are in our convention of cents on the dollar, cents on $100 of par that's owed to the banks. In our world, we bid things at a percentage of that par. So when I say 70 to make 90, we're buying it at 70% of par value that's owed to the bank and recover back 90. That's kind of where these things tend to trade.
Thanks so much, Avi.
I don't know if
There's a
there's
question in the room. Right
Okay.
Good afternoon, Avi. My name is Val Hoy. I'm one of the trustees who doesn't regularly sit on the investment committee, so forgive me if this is a little basic. But what I understand is that the play that you're after here is the underlying asset that is provided as security for a debt. So far, so good?
I'm gonna correct that a little bit.
Okay.
The underlying asset is the hostage in this drama. We would like to not shoot the hostage, but we would ultimately like to give up the hostage for value.
Okay, so you don't want
We're
to
not
end.
after the hostage. No.
You don't want to trade money for the hostage. You want the hostage to go on his or her way, because otherwise you're stuck in terms of time.
Well, yes. I would say we are not what people call a loan-to-own kind of fund. In this example, we're holding the hostage. We're holding the collateral hostage because they owe us money. We don't actually ever want to own the hostage or kill them. We would like to release the hostage but get paid for it.
Okay.
I mean, I know I just used an absolutely horrible example now that I'm thinking about it. That did not sound good, but
We
The
can
worst
leave
case scenario is that we would have an asset.
leave that. Worst case you end up with
there's
an
an
asset.
asset which has value, correct?
So what's really critical here is the due diligence, or the underwriting, as you call it, on the legal side and on the asset side, as well as understanding the politics and who the other creditors are, if there are other creditors, and all those things. Right. I mean, that's the main thing, is the underwriting.
yes, I would even add more. What makes your statement even more true is that these are pretty illiquid investments. There's no market for these. I mean, you could sell them, because just like we're buying them, we could sell them. But if you make a mistake in a bond position, you can go sell the bond. You may not like it, but there's going to be a liquid-ish market for it. In this situation, you got to work it out. So you have to be right, and you do. And this is why, when I talked about the screening, this is why it's so intensive. You can't just bid on these things. You have to do a month of work before you even get to a bid.
Is there a common pattern or circumstance that these assets are likely to have, or is everyone a one-off, different evaluation?
No, there are definitely patterns, and we've worked through the patterns a little bit. So when I said I threw out a month, I actually meant that a lot of these things, the process for a lot of these loans is sold are similar. There's usually a month to 6 weeks of first-round diligence. You have to put in your first-round bid. It's non-binding, but it needs to be serious, because when you get the call to say you're in the second round, they want best and final in like 2 weeks, and there is no way to do the legal and financial diligence on these assets in 2 weeks. So you need to do a lot of the work before you get there. Now, the patterns are, and I think this has to do with the way the U.S. market and the European market were structured differently. I think it's because the U.S. had the CLOs and the structured products in there. So in the U.S. loan market, you tend to find a lot of lenders with small positions because you have a CLO. A CLO's got $300 million. Let's take $3 million positions and a $3 million exposure and 100 positions and move on in life. The European loan market did not have this. It's much more of a bank balance sheet lending market. So you'll have a €1 billion facility with 5 banks, each one of them holding 200 million. So that's one of the patterns, is that sometimes you said sometimes there are other creditors, sometimes there's not. So one of the patterns is also to be able to create a consensus and to create a workout dynamic inside the bank group where you don't control everybody, but you kind of have to convince them what to do. This is very similar to what we do in our bond and loan business, because when you're buying bonds in the market, you're never 100%. You're always in a group. You always have to convince them, and this is one of the things we do well. I also think that this is one of the things that makes us more competitive in these situations, is that the private equity guys, they love control. They want to know that they can get their hands on the asset, and because they have a thesis that they're going to improve the asset. We don't have that. We're trying not to get to the asset. So when an opportunity presents itself that is not a controlling position or does not have a direct path to asset ownership, the private equity guys tend to drop out. And that makes it better for us.
So what are the major risk factors? Is it inability to control? Is that I assume that is a risk factor here.
There is a risk factor. I think that's more a question of timing. If you fail in convincing your fellow banks to go down a certain path, and they do not all act rationally, especially in this environment, they're very worried about write-downs. They don't want to deal with bad loans. They have a relationship with the borrower. So we have to work through that. That's more a risk to timing. The bigger risk is we got the asset wrong. We underwrote the asset wrong, or we underwrote the legal wrong. The legal, I can't think of a mistake now that we've done on the legal side because we spent a lot of time and money doing it. So usually what we think we get. If there's a mistake that's made, we made a mistake. It's either a mistake on the valuation, but more likely I'll actually say we made a bet and the bet went wrong. So let's say you're buying an office building that's distressed, and there's a 40% tenant in there, and the tenant is up for renewal in 2 years. And every check that you did in the market and all your diligence suggests that tenant is going to stay and renew the lease.
But they don't.
That's a very credit positive, and let's say you made your bet, you made the investment based on that, and you're wrong. The tenant changed their mind and decided to vacate. Now you've got a hole in the building. You're going to lose money, at least on a mark-to-market, and you're going to increase the duration of that investment. It's not what you expected to do, and that's why it happened. Something happened in the asset that was not what you thought was going to happen.
Then how do you spin straw into gold, which you described?
Well, like I said, the protection here is by being senior is that you may not get out when you want, but you're going to cash flow out, because you're still collecting 100% of the cash flow from the asset, and you're going to go work it out. So it may not be when you think it is, but at the end of the day, the asset is what the asset is, and you're going to go fix it. There's sadly plenty of straw in the place, and that's, we make bets. It doesn't always work out according to our plan, but we have to make it happen. Even I'm looking at these 5 in this portfolio. I'm trying to think if we had any real negative surprises. I think not yet. I'm looking at them. We've had 2 positive surprises in this portfolio. We haven't had any negative surprises on the underwriting. And if there is, we just have to go work it out, find solutions.
Thank you.
So,
Bill?
I had a couple questions. So most of the talk and the time has been spent on Europe, but you did mention Asia, and you've got a team over there. What percentage of your assets right now are invested in Asia? Have you invested in Asia?
Yeah, I'm going to give you an answer. Tammy's looking for the answer. I can tell you on our side, on the credit side, we are not doing a lot in Asia, although Asia, to me, is a little bit broad. I look at Asia from a distress side is really Australia and Japan. We've been very nervous about investing in other jurisdictions. We have a couple of small positions in Indonesia. They're pretty small. They're in workouts. We're in the senior position. I think they're going to be okay. We've not seen, in this opportunity set for this fund, we've not seen things come out of Asia that are large and as safe as some of the other stuff that we're seeing. So far there's nothing in here. We're very nervous about China generally. We've just hired a Chinese-based analyst. She's worked at a bunch of other banks. She's working in Hong Kong right now, obviously in our office, and she's going to cover China for us to look for more opportunities there. But I don't expect, from what I see today, I don't expect a lot of Asian exposure to be here just because we haven't seen anything that looks good, that we like enough to build a full position on anything that's coming out of there.
Okay.
Global aircraft transaction that you'll see that in the portfolio at this time, some of those aircraft are being leased by Asian carriers, so it's somewhere between 5 and 10% of the portfolio is outside of the U.S. and outside of Europe, but in general, it's largely been over 80% has been out of the European portfolios.
Yeah, and I mean, with the aircraft stuff, I'm looking at the number now, it's 6%, 6.5% Asia, but that's in these aircraft deals, and, so yeah, you have credit risk to an Asian carrier, but I don't really see that as Asian macro exposure.
Okay, second question I've got is, since screening is so important, you're talking industry risk here. Do you have any concentrations by industry? So you get senior debt, you can have it in all aircraft leasing is one example of a class. What other types of industries, or how would you break your percentage down now by industry? Because it becomes very important that you really, if you're holding senior debt, it becomes important that you understand the industry you're going into really well, because things happen by industry differently.
I agree with you. I think you have to understand the industry really well. You have to understand the value of your collateral better than the industry. But I could tell you in this portfolio now we have car parts, we have nursing homes, we have hotels, we have iron ore. It's pretty diversified as far as the underlying industry that are in there. And this is something that we do as an event manager. We're not sector specialists. We don't have teams of people that are covering transportation and healthcare and and technology and things like that. We're much more situational or product driven. And when an opportunity comes up, we get smart on it internally. We hire external consultants to understand the industry. But when you're in the senior debt position, the actual nuances of the industry, it's not that they matter a lot. They don't matter as much. If you were buying the equity in the auto parts company, you really need to know what the macro environment of the auto parts are. If you're buying the senior debt, that's backed by the locations of the auto parts companies, the auto parts industry matters a little bit less to you. What you care about is the value of the real estate, what's the rent coming in, what's the market rent, what's it going to take if we need to kick this tenant out and get a different tenant in there, and instead of having auto parts, Jiffy Lubes, we're having Starbucks.
So you're talking real estate, a lot of real estate as the collateral.
There's a good amount of real estate in here. Some of it is credit, some of it's not credit. But that's been the profile also. The two big, I would say, underlying themes in the collateral that's coming out. There's always a lot of corporate, but real estate and shipping have been two big themes. There's not, I don't think we have shipping in this portfolio. I haven't seen any giant shipping portfolios come out yet, but I think a few are going to come out. If you called us in a year, I'm going to guess that there will be shipping exposure in this fund, because I feel like some of this paper is starting to come out. There's going to be real estate. There's going to be shipping. And I'd say the other profile that I should have said earlier, but maybe I alluded to it, a lot of these bets are not corporate-y. They're more asset-y. meaning we don't have to make as much of a bet. In our regular business, we're making bets on corporates all the time. What's their EBITDA? What are their sales? What's their cost structure? How long are they going to survive? Things like that. Here, it's much more underwriting the four corners of an asset. So these are much more asset plays than they are corporate plays. And frankly, those are easier. The corporate plays are much harder because you really need, one of the things you need is that industry expertise to be able to forecast what their EBITDA is going to be 3 years from now, because that's how you're going to figure out how much debt they can support and what that debt's going to be worth. Here, if you have an office building, you know what the market rents are, you know what the leases are. After that, it's just math.
Avi, this is Val Hoy. One more question. You mentioned that you're not going for the underlying value of the asset, that the assets are over leveraged. So could you describe to me what your disposition strategy is and where the gain comes in just sort of in a good example? We talked about the worst case. What about where it works the way it's supposed to work?
I would say there's a couple of variations, and I'll say in the spectrum of disposition, I'll give you the real easy example, and these are all examples from real life that have happened, not all in this fund, but generally in our business. So one example is we go to the borrower and we say, you're totally underwater, we need to sell this portfolio, and they say, fine, what are you going to pay me? And we had a situation, we just closed on it about a month ago, we paid the operator £500,000, and he sold an asset for us that was close to 70 million pounds. And it was totally worth it because if we had to hire an administrator to throw it into bankruptcy, take it over, we would probably spend more money and maybe not get the same price. It was sold as a kind of a consensual solvent sale. We paid the guy £500,000, and we were happy to do that. So sometimes it's a consensual disposition. All the way in the other end of the spectrum, which we are, I don't want to count it yet, but hopefully we're getting paid off tomorrow on something that we were in litigation with somebody for 3.5 years over a default that we called, and they disputed it, and we fought with them. We've been in court for 3.5 years, and we're going to get paid off tomorrow because we wound up settling with them. So that's all the way in the other spectrum is the drag-out, fight-out scenario. And I would say those are the two tails. Most of what we do, the disposition is going to come in the form of, I would say there's three forms. One is selling the assets, refinancing the debt, and then selling the equity, whatever's remaining. It's going to be a combination of those three. Ultimately, we're going to get out of this, but we have to fix it first in order to get out. So sometimes you want to reduce exposure by having them sell some of the assets and reduce the loan. And either with that or without that, you reduce the leverage by converting some of the debt to equity, and then ultimately you sell the equity.
Thanks.
All right. No other questions? Jimmy? Or Tom?
Yeah, I'm probably the least knowledgeable about the investment side of it. And listening to all of this, I'm, befuddled with all of the information that's thrown around there. We're looking at the European markets, and I do know just from watching the news that there's a lot of troubled countries out there. How much are we invested or looking at investments from Greece, Portugal, Spain? All of those countries are really troubled. How much are we looking at those countries?
No, yeah, I'm going to tell you the answer in a second. In the first portfolio that we have here, we do have exposure to Spain. We don't have exposure to some of the other PIGS countries. But even if we did, I'm going to talk about Greece in a second, but even if we did, I'm okay with that, because in our business, the macro can be really bad, yet you find jewels in the micro. And that's generally how we conduct our regular businesses. We look for things that are beaten up. You can have a great asset in Greece today. Like, we're not buying it because we think Greece could, notwithstanding what happened today, could really blow up, so we're not doing anything there right now. But you can find a great deal in Greece right now, and even if the government goes into a tailspin, you still have a pretty good producing asset. Now, maybe Greece is a bad example because they put in capital controls, you actually can't get your money out. That is not so good. But, take Cyprus, for example. In this fund that we have now, excuse me, we closed on a loan, and within a week, actually between the time that we signed and the time we closed, a large mall in Cyprus that was part of the collateral got sold at a very good price. We sort of knew sale was coming, and it was crazy because the selling bank didn't figure it out, but we did. And we got a full par pay down on that loan that we bought at a discount, even though we never actually owned it. So even in a troubled country like Cyprus, good assets will trade. Even bad assets will trade. They're just going to trade at a low price. In this fund, we're not making a bet on the sovereign. It's not like we're buying Greek government bonds in this fund, so we're not really making that bet. But we are definitely going to make bets and make investments in countries that are out of favor, because that's where where there's the distress is where the opportunity set comes in. But as we said earlier, it's all about the diligence and the underwriting. And you can have good assets in a bad environment.
But you need a safe legal system.
That's one of the other reasons we're nervous about Asia, and that's one of the reasons we don't really do Eastern Europe, and that's the reason we don't really do Latin America, because we need there to be a rule of law, we need there to be respect for creditors' rights, and in those countries, they don't really have them. Honestly, they don't really have them in France either, respect for creditors' rights. But we're I know you're laughing, but it's actually true. I mean, they value the equity holders there more than the creditors. But a country like UK, Ireland, even Spain, the court system's screwed up there, but there's respect for creditors' rights. But in these countries, if you're a senior creditor, the UK is the best. UK is better than the United States when it comes to creditors' rights. If you're a secured creditor in the UK on real estate, it is no tears. Here's the administrator. Pack your bags. You're out. We're selling the asset. You're done. In the U.S., you can file for Chapter 11, and you can draw your lenders out for a year. Cannot do that in the UK. So we like going into jurisdictions that we have the rule of law and the hammer of a good insolvency system that will protect us.
All right, no more questions? Liza?
Thanks so much.
All right, thank you.
Thank you.
Thank you very much for your time. If you guys, as you can hear, I love talking about this stuff. So always open to more questions and more calls.
The whole board's coming to New York.
All right. It's a beautiful day. It's always a beautiful day in San Diego. I can't sell you a nice day in New York, can I?
I have a question for
Should we
Steve.
hang up now?
I think, Steve, are you staying?
Go ahead, Avi, and hang up.
They're
Thank you.
staying. It's just a...
Okay.
Okay, we're gonna hang up now. Thank you.
Wait, don't hang up. Did they
Oh,
hang
don't hang up.
Don't hang up.
Don't.
We need
Okay.
your line to stay open, but we need you guys to exit the room, otherwise we'll lose the call.
Is that all right?
That's fine.
Okay,
I
all right.
believe
I'm
that
gonna pack up
it's your
somewhere.
dial-in, so once they disconnect, it will go away.
Okay,
Correct.
so just, leave it. Okay. Sure, how that-
All right. Dan?
Thank you.
Step out of the room.
Thank you.
Thanks, Melanie. Miriam, are you still on the line?
I am.
Great. We're just going to take a minute and pause for just about 30 seconds, and then we'll
Can
do
we
more
mute
board.
the line? Most phones you can mute
Yeah,
the line.
probably so. I did want to have access to our analyst who's on the line, Miriam. She did the underwriting of the fund, and to the extent you have technical or very deep questions, she would be a perfect person to be able to answer that. I think we're going to have to trust Avi Friedman on the other end not to be listening right now.
Yeah, but we evicted him from his office.
Right. So that was quite a bit to digest in a short period of time, but hopefully thematically these are things that you've heard us talking about in the past, and you've heard some of your other managers that you've unanimously approved talking about in the past as well. This is a little bit different in that it's likely going to have more of a European flavor and will be more concentrated. The fees are lower. We like the terms of this investment pool. It's to have a shorter life than many of your other investments. And we like the characteristics quite a bit. Let me pause and just see what you heard that you'd like to dive deeper into, or what questions you have in terms of overall fit and portfolio context, things of that nature.
Ed, you're in the queue.
I actually have a non-technical question. Have you presented this opportunity to other of your clients, and what has been their reaction?
We have. Miriam helped me out with the exact number, but I think maybe 7 to as many as 10. And we're likely moving forward with at least half a dozen or more clients. Miriam, can you give the more precise number?
That's That's correct. We've had about 10 clients express interest and have had various stages of due diligence completed. It looks like for this first close, we have 4 clients or so that look likely to make that deadline.
And the ones that have
And
not...
it's a... Oh, sorry, go ahead.
Go ahead, Miriam.
I would just say it's a range of both public pension plans, corporate pension, and operating asset portfolio. So it's a range of clients.
There were a couple clients that just weren't able to move fast enough. They couldn't get their due diligence done. They couldn't get a quorum because of the summer months. We're pleased actually with the client uptake of this particular investment. I mentioned this to Liza earlier. There's investments that we feel good about, and then there's investments that we kind of have a high conviction in that we think are truly kind of compelling and interesting. This falls into the spectrum of compelling, very interesting investment that we feel strongly about.
Jeff? We're in the queue?
I think Jimmy's
Jimmy's in the queue first.
Oh.
Sorry.
It's a pretty short commitment time, or close time, like next week, right? Are we able to be on track to meet that? I know, Liza, we spoke briefly about the legal side of it, but as far as funding and providing the funds, can we get it done that fast?
Funding's not an issue. The issue is getting the legal documents negotiated and signed. And we actually have a commitment from Davidson Kempner that if we approve this investment today, they will give us our allocation. And then we have a couple weeks to get the documents done. Even if that extends past the close, they are fine with that.
Okay.
It looks like you have good breathing room, which is nice. We're in a hurry, but we're not. We don't need to make mistakes or cut corners to get things done.
That's good.
Yeah.
I don't want to miss anything.
Jeff?
Steve, you mentioned we had other investments that are similar to this type. How are those performing? Because it'll be similar to what this is.
Yeah, it's a great question. So the Opportunity Fund right now has a market value of about $174 million and a committed value of about $320 million, so relatively small. And most of those investments are very, very early in their life. Recall some of the real estate investments that were made in the last, say, 2 years. We really don't have good return information that we could hang our hat on and feel good about. The same is true for Grosvenor. I think we only have like 1/4 of actual return information. And some of the other investments, they have not yet called down much of your capital, so it is early to give kind of a thumbs up or a thumbs down on those investments.
And I was trying to play devil's advocate as the best I could and come up with risks and some sort of downfall, and there really isn't. It's a short duration. All the loans have collateral based. And how did $50 million come about if it's such a strong investment?
That's a good question. We would love to see more, but we felt that the size and the ability to actually get this done with them, 50 was the right number. That I'm not sure that we'd be able to get access to 100. They will be oversubscribed, that they'll have more investors wanting access to this investment vehicle than they have capacity to take. So they will be turning some folks down. And so we figured 50 was about right. That was the commitment amount that we've made to some of the real estate investments that were made in the past. The investment in the diversified fund from Grosvenor was about $120 million. So we scaled it down from that. It is more concentrated too, 8 to 10 positions, and that's a risk. Yeah, it is. It certainly is.
Bill, you're in the queue. Or Jeff, did you have more?
So that we have close to $200 million in the distressed asset investment type.
Your total opportunity fund right now is market valued at $174 million, committed capital of about 320 plus or minus, and those are real estate investments. Those are U.S. Distressed investments, fairly diversified. You don't have a lot of exposure currently to European assets.
That was going to be my question. What's the distinction between this and the other distressed credit markets that we're in?
Yeah, Miriam, I'll give a brief answer, but maybe you can give a more nuanced answer to that. So the other investments that you are in with GCM, fairly diversified, a lot of sub-funds, a lot of U.S. exposure. smaller deal sizes, much smaller deal sizes, where the underlying investor doesn't own 100% of the loan. They're a participant in a pool. Those are some of the key differences. Miriam, do you have other?
I actually have those details. For the GCM Grosvenor Fund, about 40% is in Europe, mostly in developed. About 42% is in the U.S. There's about 7% in Latin America, very small amount, 3% in Asia, and just a teeny tiny amount in Africa. So well diversified, mostly split between the U.S. and Europe.
So it sounds to me I'm sorry for jumping on the queue. I'll go back to you guys in a second here, but it sounds like to me we're taking advantage of an opportunity with Davidson because we're already in some of these markets doing some of these types of investments. Mm-hmm. So is that accurate?
That's fair. We love for you to have access to this investment manager as well as what they're going to be putting your assets into. This is a great firm, and I would love to see it evolve into something that's a multi-year relationship beyond the life of this particular fund, that we could do other business with them down the road.
Okay.
This would be a good kind of put your toe in the water at a relatively modest amount and get exposure, get experience, get comfortable, and then possibly re-up down the road.
Okay. Bill?
I think in the case of the U.S., a lot of the distressed assets from the Great Depression or recession have been worked through pretty much, but I think Europe is just beginning to, they've begun, but they have more distressed assets on their balance sheet to work with. They're pretty concentrated in Europe, so they understand that market. But it is, maturity-wise, these are very short. So that is a good thing from a duration point of view. And the thing you got to realize when you go into this kind of an asset class is that these are already distressed assets. They're already companies or whatever having problems. And so that's why they're distressed assets. So if you have another downturn and it comes quickly, you could have a real problem on your hands because now you're kind of a double whammy on it. But
right. So we're buying into Davidson's diligence that they're going to make the right calls.
Right.
And we're buying into an improved economy in Europe.
Yeah.
Improving. Thank you.
Val, you're in there again?
Yeah. So I actually think this is a high-risk investment. It also comes with a commensurately high potential return. There are only 8 to 10 assets. That's high concentration. That's risky as opposed to something spread out. One of the biggest risks I see is the exit strategy. There's no liquid market for disposing of these things. Each asset is going to be dependent on the personalities of people and the vagaries of a legal system somewhere else, and I don't know exactly who they are and what they are, so there's a lot of risk with this. There's a cooperation risk because there isn't control. One of the first things I wrote down is, do you have control? And Avi answered it before I could ask it, which is no. This is ruled by committee to some extent.
So they don't necessarily seek control of the asset. They'd rather he beat to death the hostage experience and case study. They don't seek when they buy the debt. They don't seek to get the underlying asset at the end. That's a
which is
derivative
a
that
classic
may happen.
a classic strategy for an equity investment.
Private, right. They'd rather
predatory-
not have to go there.
Sure.
They'd rather not. But they typically are the only investor in that
at
debt.
that tranche or at that level. They're the senior debt. They're not going to buy a second position or a third level.
And they don't need another investor to invest alongside them.
So that mitigates to some extent what I'm going to call the cooperation risk, because presumably they've got some measure of priority. But in addition, I think timing's a risk rather than in this kind of investment. The fact that they limit themselves, I think it's 3.5 years with 2 one-year options to extend. That's actually, to me, a risk if they have to dispose of this thing within that period of time. For example, you heard Avi talk about a 3.5-year litigation he was in on one of his assets. They can go longer than that. You can have problems that last longer than that. And so, there's a potential that you're forced to deal with assets in a way that's non-optimal because of your timing. So I see that as a risk. So I just want to make sure we understand. I see this as a very risky investment with a very attractive return. I think it belongs in our portfolio. However, I want to talk about the level. We picked a $50 million threshold level. That's significant as I look at the terms and conditions for the management fee and carried interest. You get an option at that level that you don't otherwise have.
Right.
So I'm curious, are we picking that level because we want the option to reduce the carried interest of the GP to 10%? Is that something we envision doing?
Good question. That didn't influence the original funding size. The original funding size was based upon what we think we could get and the diversification of the total fund. That was kind of the icing on the cake, that we get the ability to choose a fee that we think might be more attractive to you longer term.
And have we made that choice, or do you have a recommendation, or?
Well, I guess we haven't formally made that choice, but
we've discussed it.
Yeah.
We're leaning toward the option of reducing the carried interest.
Yes.
Yeah, we think that will
that
be
looks attractive.
Longer term, more beneficial to the fund.
Okay. Can you just comment on the terms of the waterfall as you see it, because it looks like it's a reasonable allocation between the general and the limiteds to me, but I'm not an expert in this.
Miriam, can you comment on the waterfall, but also comment on the term, the timing? And Val brought up an excellent point that what if in 5 years from now there's market turmoil and we can't sell this asset? What happens? Do they have other rights? Do they have other rights to further extend? And what is our experience with that? If you could comment on those two things, that would be great.
Sure. The waterfall, one thing, it's pretty typical for these types of lockup vehicles that we've seen credit investors. One advantage is that the management fee is charged on invested capital rather than committed capital. We're still seeing a number of managers launch funds that are charging on committed capital, and we think the invested capital is obviously much more attractive. But this is the LPs get an 8% preferred return, and unless the LP receives that 8% preferred return in addition to all their capital back, then the general partner won't get any of its carried interest. So at some point, the general partner doesn't start getting carried interest until all capital has been returned to the LPs, and at that time, an 8% annualized preferred return gets paid. So until then, the general partner, until we start seeing realizations and distributions being made of significant size, the general partner won't get any of its carried interest component. So, I think that's pretty typical for a vehicle like this. But, overall, we think it's attractive that the general partner isn't going to be seeing any return until the LPs already get their money back and get the preferred return. At the end of
other than the management fee.
Oh, sorry.
Right.
Well, yeah.
Other than the management fee, exactly. At the end of the term, if for some reason investments are realized and an 8% preferred return hasn't been reached, then there's a clawback provision so that whatever carried interest the general partner has taken up at that point will get returned to the LPs.
But there's some risk that there won't be any money there for that clawback because it will have been otherwise disposed of or distributed out to do things, right? In other words, you don't necessarily, just because you have a clawback right, get the clawback.
Well, if Davidson Kempner were to not pay back the money it contractually owes the LPs, I think that would be a very significant problem for Davidson Kempner and their ability to keep managing funds for investors going forward.
And we did staff had a discussion with Davidson Kempner specifically on the fees so that we understood it, and we involved Corey Buhan, who unfortunately isn't here today, to have his input into the fee structure because it's more private equity-like, and he was very comfortable with how it was structured, and he thought it was typical to the structures that he sees.
Miriam, can you go back and also address the investment period and the total term of the fund?
Yes. So in our discussion with Davidson Kempner, we've gotten comfortable with their underwriting fees. Their base case for each of these investments does not assume any improvement in the macroeconomic environment or industry improvements. All of that stuff is upside in their underwriting, and they're coming up with multiple exit strategies and expected timeframes over which they can realize those. So they are, this is a 18 months at which the capital will be drawn, and then a 2-year harvest period. So that's the 3.5 years. We believe that we are pretty comfortable that they are underwriting their investments to be realized within that time frame, the majority of the investment. To the extent that they miss and there is a delay in having to, if it's litigation, as you mentioned, if a restructuring, if there's some delay, or an asset sale, they have an additional 2 years is a pretty good cushion, we believe, for them to be able to work out the rest of their assets. Now, they have the ability to, at the end of the investment period, to distribute investments in kind, but I think that at some point this is where the reputation of the firm and the investor-focused culture at a firm, where you kind of trust that Davidson Kempner is not the kind of manager that's going to leave their investors holding the bag. Things like, we've seen it in a number of ways. For example, they have the ability in Special Opportunities Fund 2, the fund that's currently finishing up its investment period, to make it a very concentrated vehicle. They invested in the Spanish hotel portfolio, and it could have been as much as half of the fund. However, they limited it and ended up partnering with another investor, with Bank of America, in order to make sure that investors in this fund are not getting overly concentrated exposure to any one of these investments. We've seen this firm do things like that time and again to make sure their investors are comfortable. I think that it just comes to a level of conviction in the manager. Is this a manager that's going to do whatever they can to get and work out for their investors, even if it means selling at a loss? Some of these investments have been underwritten so that they're producing high levels of cash flow that you basically can be taken out of your cost basis through the cash flow alone if you end up just holding the investment. So if in the ultimate exit of a position they have to take a loss from where they bought it, that kind of your downside is covered just in the cash flow generation alone. So there's I'm just kind of giving anecdotes of things that we've discussed with Davidson Kempner. We believe that this is a firm that's going to do the right thing by investors, and also the way they're structuring these investments, they end up de-risking over time.
I just add one other item, and they're investing alongside of you. The partners in the organization will put in $40 million or 5% of the aggregate value of the fund. So their commitment is nearly the size of your commitment. It's nice to see that. They will be eating their own cooking.
I was very impressed with Avi and with the presentation and everything you've said about him. So I think she's absolutely right. The big question here is who you're investing with.
Right. Right.
They're their own hostage.
Jimmy?
I like the hostage example. I'm going to have to use that, hopefully in the right setting. I had the conversation with Liza and Jamie. Unfortunately, Anders wasn't here. He's home playing chef. But I was a little concerned with the 10 to 13%, target. I thought it was a little high. I thought it was a little, optimistic, and I'm an optimistic person, but I was a little afraid of it. But talking to Liza and talking to these guys, they said it wasn't unrealistic to actually shoot for something like this with this type of administrator or fund manager. But the other thing I just kind of caught my eye while I was looking through, and this is for Steve. It says max leverage on your, looks like your comparison sheet to GCM. You have 35% overall, but it's been lower obviously, and that's at the deal level. I noticed as it explains. But have you guys seen anything close to that when you're looking through the history of their stuff?
No, I'll give a quick answer. I think in Fund 2 there was no leverage, or maybe even just temporary leverage if they needed a borrowing facility for a short period of time. Miriam, can you correct me if I'm wrong on that?
Steve, I think at the time we underwrote the Special Opportunities Fund 3, Fund 2 had no leverage on any of its deals. But I think since then there might be a deal in the pipeline to close this fall that is using a modest amount of leverage, less than 50%. But my experience with Davidson Kempner has been when they're using leverage in one of their lockup funds, it's usually 1 or 2 deals for a fund like this. I wouldn't expect it to be more than that, and it's a very modest amount of leverage.
Okay. Do you know what the makeup was of the special fund 1 and 2, basically? Because we're looking at more European.
Yeah, Miriam, I'd like you to comment on that. 1 was a particularly unique fund, but if you can comment on 1 and 2, that would be great.
Sure. So the Fund 1 was investing in a portfolio of Lehman claims. So it was like, I think, over 100 different Lehman estate claims. And that fund was launched in 2013 because at that time, Davidson Kempner wasn't unique in this. The Lehman Brothers bankruptcy is the biggest bankruptcy and has been the biggest source of opportunity for distressed managers pretty much in history. And so it was one of the biggest positions in their flagship multi-strategy fund. And they raised the Special Opportunities Fund 1 in order to be able to invest in spillover claims that continued to be a good source of opportunity for the firm. And as of I think you've seen in the materials that had over a 14% IRR as of the end of March. And Fund 2 was launched in July 2014. And this Fund 3 is really the continuation of Fund 2. So you have seen in Fund 2, again, it's still investing. So I think there are 2 to 3 more investments that will close before the fund is finished. But at the time we underwrote the strategy, it was more than 80% exposed to European bank sales, and a lot of that was real estate-backed loans. I think roughly 70 or 75%. And then in addition, Avi mentioned a couple other exposures. There was the aircraft portfolio, as well as the construction loan to an iron ore pellet plant, and I think that covers all of the investments that were made by the time we underwrote this strategy this summer.
Thanks, Avi. Going through all the paperwork and talking to Liza and to Steve and Avi, thank you, or Mary, I'm sorry. It's definitely a good fit for our opportunistic, area of our portfolio. Liza, what does this bring us as far as our allocation in that area, percentage-wise?
Steve actually calculated that out.
Still fairly modest. So the board-approved limit is 8%, and right now, on market value basis, you're at 3.3%. This would bring you on a committed basis, so assets not yet all drawn down, at 4.7%. Okay. So if every manager called you tomorrow and said, "We need you to fund us fully," you would be at 4.7%. Which is, we think, a nice position to be in.
Still gives room.
There's a lot of wiggle room to do other things down the road if there are things to be done.
Sounds good. Thanks.
Bill?
I'm finally getting kind of a sense. This is mostly a real estate fund. But if 75% was in real estate before.
Or real assets.
Distressed real estate, right?
Yeah.
That's the collateral that's backing all this. So if we take a look at our total real estate position, we've got, I think, about 10% we're allocating in the real estate side.
11.
We've got a couple REITs and 10 managers doing globally. How much of it is in Europe currently? How much? This is a European real estate play, really, distressed real estate play. How much is in Europe?
In the real estate portfolio, we only really have exposure. Well, we have a global REIT manager, so that obviously has some exposure. We only really have 2 funds, and it's the 2 Europa funds we have.
And that's pretty much it in European real estate.
Mm-hmm.
Okay. Well, I think where I am is it's an opportunity fund investment. It's something, a known product class and everything. It is riskier, I believe, but the returns may, short duration may give us a good return on it.
Mark?
I wanted to thank the board members for sitting through this stuff. For Tom and Alan and Val, the investment committee has meetings that run a little bit longer, and you can get a feel for why that's the case. So I appreciate you asking some very good questions. We are taking probably twice as long as we anticipated going through this thing, but it's all very good input, so thank you for digging in. Liza did have a chance to reach out to Karina Coleman and talk with her prior today. Karina doesn't have a vote as a board member, of course. She would have had a vote as an investment committee member, and her questions were answered. She was in support of this, so I just wanted you to be aware of that as well. And then you heard at the July board meeting Ann Hewitt talk about our long-term capital market assumptions and where they expected things to go. If you look at the long-term rates of return by asset class, there's only 2 asset classes that have a return that's accretive to the 6.58% that they were projecting, and that's private equity and I think emerging market equity, which are riskier investments. So we need, as you probably have long since figured out, we need to have some riskier investments in our portfolio. Not a lot of them, but some. This represents less than 1% of the portfolio, so that's why Straff is certainly recommending it. We need to have some blend of more conservative stuff, which is obviously what most of our portfolio is.
Thank you, Mark. Nobody else in the queue, so do we want to vote and then bring them back online? Is that the plan?
No, we just need to vote.
Okay.
And then we're done.
Okay. All right. So with that, since there's no more discussion, I'll need a motion up and a mover and a second. There we go. Motion to approve staff and consultants' recommendation for a $50 million commitment to the Davidson Kempner Special Opportunities Fund. Mover of James Steele, second of Val Hoy.
Ready to vote? All votes are in.
And the motion is approved, 7-0.
Fantastic. Thank you.
Thank you, Steve.
Thank you.
Very good.
Miriam, thanks.